Hi, everyone. Thanks for joining the Dairy Business Association and Edge Dairy Farmer Cooperative today. The Biden administration is very focused on a new infrastructure plan worth possibly trillions of dollars, as we're all aware, and they need to find a way to pay for it. Unfortunately, agriculture operations have found themselves in the crosshairs. We know that there is some momentum to tweak how it would be administered to farmers from ag champions on the Hill, but we can't count on being carved out and need to be aware of all options on the table. We've heard concerns from a lot of our members and about what this will mean for them. So we're happy to that you could join us today for an informational webinar on how the proposed changes to the tax code could affect your operation. Today we're joined by a team from CliftonLarsonAllen, Austin Burby, and Mark Diederich, who are both principals at CLA in the agribusiness and cooperative groups, providing specialized tax services for farm service and supply cooperatives, and also helping farm producers effectively manage their taxes and plan for succession and transition. Austin and Mark will give a presentation, and then we will open it up for questions. Please put your questions in the questions box on the side of the screen, and we will address your questions after the initial presentation. Mark and Austin, thanks for being here. I'll turn it over to you for the presentation.
All right, very good. Thanks so much. Yeah, and so we're going to now go over again some of the impacts of the Biden tax proposals, and we're going to try to keep it as specific as we can to the dairy world, the dairy farm industry here. Before we do that, just a couple brief pieces here. So agenda, again, just some basic introductions. Then we're going to talk about the income tax changes in the proposals, and both from some of the good that's in there, because there are some good things actually in there as well that are worth mentioning, but also some of the costs, some of the negative, right? And that's really where a lot of the time is going to be focused. Then also want to cover some of the transfer tax proposals, and then the estate tax proposals, and then obviously we want to leave some time for Q&A and do our best to answer as many questions as we can there for you guys. So again, just brief introductions. Again, Austin Burby, CPA, principal in our agribusiness group here in the Middleton office. You have my contact info there. I'm joined today by Mark Diederich, another agribusiness principal up in our Green Bay office. Mark, I don't know if you have any other kind of commentary that you'd like to add here quick, but if not, on our Q&A slide at the very, very end, I also have our contact info posted on up. So if there are questions that we don't get to, or there's something else that comes to your mind later on, please feel free to reach on out to either one of us directly. Happy to answer whatever questions we can at that point. All right. So let us talk now about some of the benefits that have come out of these tax proposals, or again, maybe some of the more positive aspects of this. One thing kind of interesting is some tax credits for the electric heavy vehicles. Right now, there's only credits out there for passenger autos. Obviously, this is an area that there's a ton of momentum behind. You can't drive anywhere nowadays without seeing electric vehicles and some of these alternative fuel vehicles. So it's just a matter of time before they kind of start breaking into other aspects of the business world. So this is one area that's actually kind of a neat area for some tax credits. You know, how much traction is it going to have in the dairy and the farming world specifically? I think time will tell. As the technology advances, you know, we might see some more uptick there. But currently, again, there's nothing out there for electric heavy vehicles. There's proposals to put in a series of different credits. Phased out starting in 2025. They completely go away in 2028, so short-lived, which is not unusual. And then again, you can see for the different class weights there, kind of what those credits could be. Again, something that is going to be super relevant to the dairy world, I don't know, but kind of neat, worth pointing out. Again, one of the interesting things that are in there that I think most of us could agree in general, not a bad thing. So one of the other really, I think actually one of the good things that is in here is some changes to the way the ACA premium tax credits are calculated and then capped. So just to recall, this comes out of the Patient Protection and Affordable Care Act, Obamacare, however you want to know it by, right? And there are credits available for those individuals who have to go out onto the insurance exchanges and purchase their insurance over the exchange. And basically, under current law, if you're over 400% of the federal poverty line, there's no credit, and it's a hard cliff. If you are $1 over, your credit goes to goose eggs. And that's pretty, it can be a pretty dramatic change for a lot of folks. Mark, I'm sure you've seen it too, doing tax planning, all of a sudden you're starting to get tiptoeing up to that line, and all of a sudden it's okay, well, what do we got to do to try to bring that income level down again? Because it can change an answer really quick. For 2021 and 2022, I believe this came out of the CARES Act, due to all the coronavirus relief. They did put a cap in there that said if your income is over the 400% of the federal poverty line, there's going to be a cap that basically limits your out-of-pocket premiums to 8.5% of your AGI. So again, we're trying to mitigate some of that cliff effect and those blows. And then there are lower rates for lower levels as it relates to the federal poverty line. So again, under these proposals, under Biden's Green Book proposal, he would actually make that 8.5% cap permanent, and the lower rates across the rest of that federal poverty line spectrum would also be made permanent. So again, from that perspective, not a terrible answer, not a terrible proposal. Some of the other areas where there's a lot of movement recently, and specifically within Biden's plans, are the different child and dependent care related credits. Right, so these are going to be some provisions that are really going to be beneficial to the younger operators, the starting out farmers with a couple kids still running around at home. These will certainly be relevant and certainly could be beneficial. So currently, there's maximum credits of about $1,050 for one child, goes up to $2,100 for two or more. For 2021 only, again, it was stepped up even more because of some of the coronavirus response aid. And again, these are for costs incurred while you're working for dependent care. So these are credits related to those costs. Again, under Biden's Green Book proposal, these 2021 changes would be made permanent. So that is, again, could be a huge benefit to a lot of our younger dairy families in particular. Then there's also the child tax credit. So again, we got the child dependent care credit, which is for costs incurred to get to work, or so that you could work. This is just because you have the kids. So again, current law, $2,000 per child under the age of 17, up to $1,400 of that is refundable. For 2021, again, very similar. It was boosted up in response to all the coronavirus issues. So up to $3,000 per child between ages 6 and 17. $3,600 per child up to 5 years old, and they were made fully refundable. So huge benefit, huge benefit. Again, Biden's Green Book proposals would make those 2021 changes effective from 2022 to 2025. So we would extend those out a handful of years, and then we would revert back to the old rules in 2026. So a little bit shorter lived, but again, could be actually be a really good benefit for a lot of our younger dairy families, especially. So worth pointing that out. Something else, again, kind of interesting. I'm not sure how applicable this one will be in the dairy world outside of maybe some of our real large producers or real large operators. But this is kind of a little known credit that's out there. But I think given some of the other movement in the marketplace, might be something worth thinking about a little bit, again, especially for the larger operators. So there are credits available for employer provided childcare. So if you're an employer, you're the operator, and you provide childcare or a childcare facility or referral system for your employees, you can actually take a credit up to 25% currently of those costs, and a maximum credit of up to $150,000 per year. Now there's a whole bunch of qualifications and kind of different qualifiers that go onto that, but in general, again, not a very well-known credit. Under the Biden Green Book proposals, that tax credit increases up to 50% on $1 million. So maximum credit of $500,000 to, and I've actually got some notes over here, for employers to provide child care facilities or a contract with an outside facility for the provision of care. Qualified expenses would include acquisition, construction, rehab, expansion, facility costs, operating costs. So I mean, pretty robust. Again, how applicable will it be to the dairy world? I don't know, but kind of a neat one that's out there. And again, I think one that in general, a lot of folks could look at and say, that's not a bad thing. To be able to help some employers take care of their folks. I know in my own client base, my operators, my producers, they care about their people. They want to take care of their people. Practically, the labor market is so tight, they have to take care of their people, right? And I'm sure many of you guys are feeling that same thing. So this is an interesting one that's out there. An expanded credit may be worth something, may be worth considering. It could be. With that, let's switch over to probably what more people were expecting to hear, some of the costs, more of the negative side of this. So, right, all this has to be paid for, no secret. So let's kind of take a look at how the Biden administration and others proposed that we would do that. First and foremost, the corporate tax rate. Again, current law, 21%. His proposal would increase that to 28%. Again, flat rate, no progressive structure to this, no brackets. In terms of proposals that are, or pieces that are likely to pass, this one's probably some of the lowest hanging fruit, I think, in front of Congress and Senate. I think it's pretty easy to team up on the big evil corporations, right? And because they're faceless, and that sounds good to a lot of the politicians. So of all the different provisions that we'll talk about, my own instinct would say that this is probably some of the more likely stuff to see increased. We could talk about whether or not it makes sense compared to international markets and all that, and maybe that's something that we can talk about in the Q&A. But in general, current rate 21%, proposed rate 28%. There's been a few other proposals on maybe kind of splitting that difference and going to like 25 or 26, but 28 is what is officially inside of the Green Book proposal. So the top individual rates. Now, this is another area where there's a lot of conversation, right? So current law, top individual tax rate, 37%, and that's at about $628,000 for a married filing joint, about $523 for a single taxpayer. This would be increased back to the pre-2017 levels of 39.6%. And again, that's now here's the other change that they haven't told us about as much. They've actually shifted those brackets back down. So not only are they proposing to bump those rates back up, they're actually sliding the bracket over as well. So now you'd hit that top rate at just over $500,000 of income for a married filing joint, and about $450K for a single taxpayer. Fairly significant change there. Just in addition to the increase in the percentage, again, you're talking $120,000 of brackets movement on the married filing joint side of things. These changes would be effective for 2022 at least. There are some other changes that wouldn't be, so I do want to point that out. The other thing that's not getting a whole lot of attention here, as I've labeled, but wait, there's more. There's always more, right? Net investment income tax changes. So in addition to these brackets moving and these rates moving, there's some very significant changes to the net investment income tax. Basically, nearly all sources of income, once you get over the $400,000 mark, basically everything but wages, essentially, could be then subject to the net investment income tax. So in addition to your 39.6%, you can tack on another 3.8%. So we're talking a top marginal rate from a federal level for folks at 43.5%, 43.4%, pretty significant. The capital gains rate is the other area that probably most conversation, I think, seems to be centering on here. So right now, current law, 20% rate on that capital gain income once you reach about $500,000. Changes a little bit between married filing joint, single, etc., but to keep it simple. Proposal here would be 39.6% over $1 million of taxable income. So just to make this really clear, because there's been a lot of confusion, I wanted to throw in a little bit of an example. So Bill sells land for $1 million long-term cap gain, total taxable income of about 1.4 million. Only 400,000 of that long-term capital gain would be taxed at that 39.6%. But then you'd also have that 3.8% net investment income tax. So I think examples are helpful. We're start talking about some of these changes because there's a lot of moving pieces. Again, this in the dairy world, especially if you start thinking about your raised cull cows, we start thinking about land transactions. This could be something extremely relevant, as well as sales of maybe you got some S corp stock you're trying to transition, sell out of, and this is going to be a very, very relevant issue as we go forward. Should this stuff all pass? Another area where there's not been a whole lot of conversation on it, at least I've not heard a lot of conversation on it, and I see Mark shook his head there too, would be the self-employment tax changes for partners and S corp owners. So right now, and a lot of you probably curse this every year around April when you're chatting with your tax guys, trying to understand how the tax bill gets to where it is. All right, so right now, current law, you have self-employment tax on for your general partnership interests, and your sole proprietors. You're going to have self-employment tax, but it's something that we can manage very, very effectively using member-managed LLCs, and then the S corp structure is a great way to mitigate that issue. Now, the changes here, and admittedly they're not entirely clear in the Green Book actual write-up. So there's some liberty taken here trying to interpret what it is they actually mean, full disclosure. But his proposal would suggest that the SE tax now is going to apply to all business income of partnerships, LLCs, and S corps for the materially participating owners. So your owners who are actively involved. Which is again a change because it used to just be your general partnership interests. So now it's going to apply to all of that income. There are exceptions for rent, dividends, capital gains, etc. That's not considered self-employment income. That'll get hit elsewhere. So again, currently 15.3% additional tax on that self-employment income. Now the proposal would pull all that business income. It appears it would be at a lower rate though. So that's maybe the one caveat to this. It should be at the 3.8% level. So what they're basically trying to do is mirror up the net investment income tax and the SE tax and kind of try to bring those two things together to create some parity between the different business types, it seems like. Again, this part of the Green Book proposal, admittedly, is not the most coherent, not the most well spelled on out. So some liberties taken here, but worth noting, from a planning perspective, one of the things I know that we're going to have to start thinking about on a go-forward basis will probably be the use of commodity wages far more frequently. I think it's already an underused area for compensation, but with the self-employment tax changes could become far more relevant. The other area here that I think there's been a lot of conversation on, 1031 exchanges, right? So something that should be very familiar to everyone on the call. 1031 exchange right now, right? Unlimited gain on real property. You can defer it by rolling those gains into another property, and then eventually the way this becomes an ideal transaction is eventually at death, you get to step up in basis and all of that accumulated gain that you have rolled goes poof. Current proposal would be limiting 1031 exchanges or the deferral, that gain deferral, up to $500,000 per person per year, and $1 million for a couple. So they're not doing away with it altogether. That has been a topic of conversation in prior tax reform eras, I guess we'll say. But then the other thing that comes into play here, and we'll talk about this at a little bit more length, would be the transfer tax at death on that appreciation. So this now really becomes, it changes from an opportunity to gain some permanent savings long term to really a true deferral mechanism. Under the current proposals, you're not going to escape this entirely. Excess business losses. So this is something that came out of the 2017 tax reform. And essentially this limits the amount of business losses that can be used to offset other income in your individual tax return, right? So excess losses, to the extent that you have losses that can't be offset with other income, they carry forward. So it's not like they're lost entirely. They do roll forward, become net operating losses. One of the big things here is that wages cannot be used in this calculation. So the amount of business loss that you can use to offset your other income is pretty limited. And you're essentially limited again to that business income, other business income in the return, plus this threshold. Now, this would expire at the end of 2026 under the 2017 tax reform. Biden would propose to make this a permanent fixture. Basically means your tax preparer also now has to keep another set of tracking schedules for your net operating losses. So I want to move on now, and I want to make sure we also keep enough time for Q&A here. We're going to move on to the transfer tax, and then we'll cover some estate tax issues as well. So quickly, this is an area that right now, frankly, there is no transfer tax. There's no capital gains tax on transfer to heirs or to others at gifting or at death. We have the estate tax. That is its own separate regime, though. What this is separate and distinct from the estate tax. And I think that's really, really important to note. So again, current law, no capital gains tax. Biden's proposals would actually pull in all the proposals from the STEP Act, which I believe this all originated from. And basically you end up having a capital gains tax on transfer either during life or at death. So to the extent that you gift some assets and it's gone up in value from when you originally purchased it or acquired it, you could have a capital gain transaction, even though you did not sell it. Again, you're just moving it. There is a proposed exemption built into this of up to $1 million per person, and it could also be ported to a spouse. So if you don't use up that full $1 million per person, that extra could be carried over to a spouse. One other item to note in here within the proposals, there is an extra $250,000 that's basically carved off for personal property and personal residences. And again, that's per person. So you still do at least have $500,000 of overall exclusion for gain on a personal residence. But just $1 million per person otherwise is pretty low. And I'm sure many of you on the call, if we're talking about some legacy farm operations, probably have significantly more than that in just land value currently. So what does that mean to the farm? Well, there's some questions here, and if you listen to the USDA, they contend that 99% of farms this will never impact them. I think that really comes down to the question of how you define farm. If you pull in every single little hobby farm or everyone that gets a CRP or some sort of county cost sharing program, then maybe. But for those that are actually operating, true producers, I can't think of many, and even just my own client base, that wouldn't be impacted by this, quite frankly. So some good news, if we can call it that, this tax could be paid over 15 years, and the IRS is authorized to require security if they deem it's necessary. So I do want to be clear on that. And they're given quite a bit of latitude in terms of defining what is that required, and also IRS has given a lot of latitude, a lot of leeway in kind of fleshing out the rest of these regulations, which is important because it gets down to some of these next points here. So if they're again, for farm families and other small businesses, there are exceptions to the recognition of this. So if the operation continues in the family, you can defer this. Well, first part of that question is, well, whose family for these purposes? Is this lineal descendants only? Does it include nieces and nephews? Kind of important considerations. Also a question of how long. Well, the proposals would say until time that it's no longer a family business or that it's sold. So then the second part of those questions becomes, okay, well, if we sell the business as an example, does that mean we're picking up tax on that transaction plus this original transfer tax that we've deferred? At this point, we just don't know. Again, there's not, this isn't fully fleshed out within the Green Book policy proposals. So this would be something that if it does pass, we would have to wait and see what the actual regulations look like before we get some clarity. This is one of those areas that is scary in my own perspective, from a planning perspective, trying to figure out how we make some of this stuff work should it go through. Cost basis, you know, a lot of this revolves around trying to remove that step up in cost basis at death. Current law, right? If you gift an asset, it's carryover basis. At death, it all steps up to fair value. Well, this proposal would have the effect of continuing carryover basis if transfer tax is not paid. If that transfer tax is paid, then it becomes fair market value. At death, it also goes up to fair market value. But again, note that it's not a step up. It's only adjusting to fair market value because you actually paid the tax on it, even though you still have the assets. So that is a very fundamental change in policy and law. Another area that is not getting a lot of attention with this is the discounts. So right now, if you were to gift, if you were to do a related party transaction, there are different discounts that can be taken on the values of those assets to make it a little more palatable. So discounts for minority interests, the fact that it's closely held businesses, those can drop the value of the entity down. For purposes of the transfer tax here specifically, the proposal rules out essentially all discounts. Which is, as a side note, just really, really interesting because that actually goes directly in the face of a lot of case law around the valuation and gifting in estate arena. So that's always been a sticky issue. So the fact that they just do away with it entirely under the transfer tax provisions is really, really interesting. But very, very unfavorable change as well. And we'll kind of continue on that with some other slides here too. Another big change, distributions from the LLCs, partnerships and trusts. Right now, you can take distributions out of these pass-throughs tax-free. You end up getting carryover basis in them. Now, distribution of appreciated property would become taxable. Again, it does come up to the fair value, so you do get a stepped up basis of sorts, but only because you're paying tax. The other big change there is with trusts. They're basically forcing a gain recognition event every kind of 30 to 50 years, depending on which version of this provision gets passed. To the extent that there's appreciated assets inside of a trust, they're going to create a taxable event out of it. And again, I think it's every 21 to 30 years, most likely, proposals I've seen, you'll end up having a gain recognition event. So trying to significantly reduce the ability to carry over intergenerational wealth through trusts. So right now, maybe the one bright side of this whole thing is that giving to your spouse or to charities, there's really no changes there. So that would not generate a tax on the transfer. Charitable remainder trusts, I think in the interest of time, let's pass by this one for now and just kind of jump to the estate tax. I think that's probably going to be more interesting to folks here. So full disclosure, again, Biden's proposals, the Green Book proposals, don't actually specifically address anything about the estate tax itself. So what we've kind of done here is kind of look over the STEP Act, the other 99.5% Act, which is one of Bernie Sanders and Elizabeth Warren's proposals that are out there. And then also just some of what we've heard Biden talk about, both on the campaign trail and since, in terms of estate tax proposals, and kind of try to bring them together into some sort of coherent thought in terms of what it could look like. So currently, we have an $11.7 million per person exemption, and that is indexed for inflation, right? So you could die or give away during life, die with or give away during life, $11.7 million of assets before having to worry about the estate tax. Proposed law, that drops to about $3.5 million. And in addition to that, they bifurcate the estate and the gift tax exemption to create a separate exemption for estate, separate exemption for gifts. That gifting exemption then would be $1 million. And that part would not be indexed, or at least based on the law, the language we've seen so far, that is not indexed. So that is a huge change. That is a huge shift in the law. Another really, really big swing, very taxpayer unfriendly swing, would be the annual exemption. Now, the annual exemption, you're allowed to gift $15,000 per donor, per donee per year. So really simple example. Again, I like examples. You have married couple, they each have 2 kids. Their kids are also married. You could gift up to $120,000 per year, $15,000 per donor, per donee per year, $120,000 really, really quickly without having to worry about estate issues or gift tax issues. Very powerful wealth transfer mechanism. Very powerful wealth transfer mechanism, and also a very powerful succession and transition planning mechanism. You can transition a lot of business ownership interest in that same way. Under a lot of these proposals, you would still have a $15,000 annual exclusion for cash and other liquid assets that would be indexed, but gifts to trust, gifts of pass-through entities, or other similar kind of hard to value assets, you'd be limited at $30,000 max per year per donor. So again, very, very big change there. One thing to also note here before I move on, again, we talked about the discounts. So if you take the reduction of the discounts into play with this as well, you can see now how not just from a wealth transfer standpoint, but also a business succession transitions planning standpoint, if you're only allowed to give up to $30,000 of value away per year of these pass-through entities, if gifting those LLC units or those S-Corp shares to the next generation as part of that succession plan, without the discounts, with this limit, that job becomes much more difficult. Much more difficult. Probably one of the scarier slides, the estate tax rates. Current law, 40% once you get over that $11.7 million per person exemption. That is a flat rate. Proposals under the for the 99.5% Act, again, I believe is what it's called there, kind of a mouthful. It's on a bracket, 45% all the way up to 65%. And again, notice you're hitting 45% at just the $3.5 million exemption. Once you get over the $1 million of gifting, you would also then have gift tax at that same rate start to apply at that point. Once you use up that $1 million lifetime exemption there for the gifting side. So again, fundamental change in the estate tax law from that perspective as well. Trusts. This is an area that current law, there's not a lot of restrictions, but the rules are extraordinarily complex, which is good because it's extraordinarily flexible. You can do a lot of things with trusts from an income tax perspective, from an intergenerational wealth transfer perspective. Basically, under these proposals, you're going to be limited in how much you're going to be able to transfer long term. Again, we talked about these gain recognition events every kind of 21 to 30 years or 50 years. There's going to be a reset basically where the trust is going to have to pay some tax. That's going to limit the ability for these dynasty trusts especially to be able to transfer all that wealth on to more distant generations. Also does eliminate the generation skipping transfer tax issue, which maybe that's a good thing, but again, the way that we end up getting there isn't good. Changes a lot of the use of how we would use grant or retained annuity trusts. Again, I had a slide we skipped over earlier about charitable remainder trusts. There's limited benefit there now as well. Probably more practically, the use of intentionally defective grantor trusts, these IDGTs, are essentially negated within these proposals, because you're not going to be able to use the discounts, number one, and you're also not going to be able to defer the realization of that transfer gain, that transfer tax gain. So to the extent that you would otherwise use those in your estate plan, that just goes by the wayside. So this is an area that this could almost be a whole seminar in and of itself on just the trust piece. We're not going to do that. Just some high level things to kind of be aware of, probably something to be thinking about and reviewing, think about when you review your own plans, but a conversation that you would definitely want to have with your attorney, with your CPA, your advisor. Should a lot of this stuff come on through, this will certainly be changed. So now with that, I want to open up to Q&A, and I've not been watching the chat window here. I do have it up to my left, but if there's questions, please feel free, start throwing them in. We covered a lot of material. I wanted to make sure we covered it quick to leave time for questions. So if there's something that you want us just to go, back a few slides and review, again, please, by all means, let's do that. We have plenty of time. I think we still got 20, 25 minutes or so. So with that, I'm going to open that up. I'm just going to stop talking here for a minute.
Thanks so much, Austin. Great presentation. I don't see any questions yet in the question box, so everyone, please feel free to add your questions as we go. But I guess just starting out, if I'm a producer who's thinking about retiring soon, how do I take these possible changes into account, or do I wait for the changes to be made to start making some changes to my succession plan?
Yeah, and that's an excellent question. That's the question that I'm starting to get more and more frequently. And then Mark and I talked yesterday, and then kind of on the same page with this. This sounds very doom and gloom, a lot of negative changes. But again, I think where we both stand on this is right now, let's just also step back and think about it. Right now, we've got midterms in 22, another election in 24. Most of these laws we're going to set to change in 2026 regardless. So I don't think we need to panic yet at this point. That said, if your current estate, your current overall value is on the upper end of like the estate tax spectrum, I suggest you need to be having these conversations, and you do need to be talking with your advisors. You do need to be talking with your attorneys about some of those what ifs. If you already have a succession plan in place, I do think it is important as well to start thinking about, okay, well, if these changes occur with trusts, as an example, what does that mean? What kind of assets are inside of those trusts? Would they be able to afford that liquidity event, having to pay those taxes periodically? I do think it's good to start thinking through that. But again, I think the message that Mark would also share with me is we don't need to panic about any of this stuff just yet.
The main thing is looking out 3 to 5 years, and that's the time frame that we want to focus on. Just narrow up the focus a little bit, because things are going to change. So it's just a matter of having all our tax bases worked out, what our cost and some of this stuff is, so we can make some decisions as we move along and seeing where we're at today.
Yeah, I agree.
Thank you. Another question here is there anything about the new tax laws being contemplated that would be retroactive in nature?
Yeah, great question. And yes, there is. So the changes to the capital gains rates in particular would be made retroactive to April 28th, 2021, which coincides with the release of, I believe it was the American Family Plan, or maybe it was the American Jobs Plan. So those changes going back to, let's see, we can just scroll on back. give everyone a little bit of epilepsy here. So these changes here, these top capital gains rates, right? This would be effective for transactions after 4/28/21. So excellent question. Everything else, so far as it's laid out in the proposal, would not be, though. It would be effective for years 1/1/22 and forward.
Okay, thank you. I know you mentioned earlier that the corporate tax is kind of something that you see as more of in the cards for actually happening. Well, another question here is, what's your opinion on the chance of this being passed?
Yeah, I'll give my opinion, and then Mark, you can pop in on that as well. I think I do think, again, the corporate rate change I think is probably low-hanging fruit. I think the income tax changes, I think we'll see elements of it. I don't think we're going to see all of them, though. Again, the good news is there is a very, very, very thin majority, obviously, in the Senate, and there is opposition to some of these very radical changes. Let's just call it like it is. A lot of these changes are pretty radical. So I don't think it's likely that we will see, like on the estate and gift tax area in particular, I don't think we're going to see all of that come to fruition in its current form. I think elements of the STEP Act, I think elements of for the 99.5% Act, I think we'll see elements of those things make its way into law. But again, I don't think in their current form that they could pass both houses. From an individual side of things, a lot of the conversation that I'm seeing, a lot of the commentary I'm seeing is we would expect the top rate that might go through. The changes to the capital gains piece might get tempered back a little bit. A lot of people don't expect to see that go all the way up to the top rate. Maybe again land somewhere between that 20% and the 39.6%. Maybe it's a 30% rate plus the net investment income tax. But there's a lot of concern. Well, if you raise that rate so high, are we going to stifle a lot of that activity? There's economic theory to back all of that up. We won't go into that because we'll watch the attendance markers drop off real quick. That's just my take. I don't know, Mark, what are your thoughts on some of these things?
I think the main thing here is you're going to see the tax rates go up, the corporate rate, individual rates. That's the easy one to do. The state, and that part gets much harder. So I think there's a lot more people are going to buck that one. So that one's going to be a lot harder to change, but I think you'll still see some changes there. It just won't be that drastic. So,
yeah.
Thanks. One other question remaining here is, when do we anticipate these changes going into effect? I think you touched on a little bit of this, but if the bill were to pass, say, December of this year, when would the changes go into effect?
Yeah, and so the big thing here would be the capital gains related piece. Again, the top gain rate on gains over $1 million, or the top individual rate on gains over $1 million, that would be made retroactive. So if it passes on the 11th hour, even if it passes at the beginning of 2022, it would still be made retroactive all the way back to April. Again, I think it's April 28th of 2021. That is a huge swing in terms of timing there. It makes planning extremely difficult from a capital gain transaction perspective. The balance of the changes, again, based on the language in the Green Book proposal, the actual document, those wouldn't be made retroactive, but instead would come into effect 1/1/2022 and forward.
Okay, great, thank you. Well, I don't see any other questions at the moment. So if any other last minute questions, please send them in. But if not, thank you two so much for the great conversation today. I think this was extremely informative. And so we really appreciate your help. Any last words?
Well, again, I mean, if there are questions, again, please, take a screenshot or jot down our contact info. Again, I'm in the Middleton area. Mark up in the Green Bay area. Yep. both of us, more than happy to connect if there's some questions you want to ask offline, or you get to thinking about it on your drive home later today and just stewing on it, have something pop up. Again, please feel free to reach out, shoot us an email, give us a call. Happy to help.
We expect changes, so we don't know exactly what's going to happen yet, but
yeah,
change is always normal for tax anyway. So
that's right.
All right. Thank you so much, Austin and Mark and CLA, for participating. We appreciate it so much. Everyone, thank you for joining us today and have a great afternoon.
Thanks so much.
Thank you.